RMH has opened its books. The investment holding company, which focuses on property, has posted a 25% drop in its half-year net asset value. That's due largely to three factors. Firstly, Artaberry's underlying net asset value remained static during the period. Secondly, the group paid out a special dividend of 327 million rand in January, and a further decrease in Diversity's fair value also weighed. Looking ahead, the firm says it will continue with the monetization of RMH property with the aim of returning maximum value to shareholders. All three of Growthpoint Properties' domestic portfolios are showing improved performance. That's despite challenging economic conditions in South Africa. In the 9 months to end March, vacancies in the firm's local portfolio improved to 8.5%, while internationally, Growthpoint says its investments are in line with guidance. But the Real Estate Investment Trust says high interest rates have weighed both domestically and globally. And given that, it's reaffirmed the group's guidance of a 10 to 12% decline in full-year distributable income per share. Growthpoint will release its full-year results on September the 11th. FirstRand has forecast higher annual profit. The banking group says its headline earnings per share could rise by up to 5%. That's as its portfolio produced a stronger underlying performance than anticipated in the second half of the financial year. It's added that the macroeconomic environment in most of its jurisdictions was characterized by persistently high interest rates and inflation, which resulted in ongoing affordability pressures, particularly for households. Former Pick n Pay CEO Pieter Boone was paid close to 16 million rand to leave the position early. That's according to the retailer's 2024 annual report. Boone exited the group following the disastrous rollout of his Ekuseni strategy. This prompted the firm to hire its former boss, Sean Summers, to keep the company afloat. Orion Minerals has requested that its shares be placed in voluntary suspension. That's as it readies itself to make an announcement on a capital raising. The suspension will stay in place until the 1st of July or until the announcement is made, whichever comes first. Today's move follows a request for the company yesterday to place its securities in a trading halt. Consumer confidence has continued its upward trend. The FNB BER sentiment indicator rose to -12 in the second quarter, building on the improvement seen in the prior period. The survey was conducted during the first 2 weeks of June. That's after the results from the national election were declared, but before the formation of the Government of National Unity was finalized. FNB says the results show that some consumers were probably still quite uncertain about which parties would join the GNU. It's added that the reading is the highest in 18 months and points to a gradual improvement in consumer spending compared to the very weak performance recorded over the last year. Fuel prices are set to drop next week. The AA says major decreases are on the cards for July, particularly for petrol, which will bring much-needed relief to embattled consumers. It cited data from the Central Energy Fund. It will mark the first time this year that prices have fallen in 2 consecutive months. On the international front, BP's new CEO has imposed a hiring freeze and paused new offshore wind projects as he places a renewed emphasis on oil and gas amid investor discontent over the firm's energy transition strategy. Here's more detail in this package report.
BP is having a change of heart on renewables. New boss Murray Auchincloss has decided to slow investment in big budget, low carbon projects, particularly offshore wind farms. That's all according to Reuters sources. It marks a stark reversal of the direction taken under predecessor Bernard Looney. He tried to drive BP away from dependence on fossil fuels. That strategy didn't impress investors, however, with shares in the firm underperforming other big oil players. European rival Shell has already scaled back its investments in many renewables. Now the sources say Auchincloss wants to prioritise investing in and even acquiring new oil and gas assets. Green energy projects will be assessed to see if they can deliver quick returns. The firm has reportedly already reassigned people who had been tasked with finding more such projects. Some jobs are also expected to be cut in the low-carbon sector, though the sources say no targets have been set. A company-wide hiring freeze is also in place. Auchincloss has promised a pragmatic approach since taking over from Looney in January. He's aiming for $2 billion in cost savings by the end of 2026.
And a UK-based human rights group has launched a legal campaign to block Shein's potential London listing over concerns about its labour practices. This is according to a law firm representing the campaign group. Here's more detail in this report.
A human rights group has launched a legal bid to block Shein's expected share listing in London. Stop Uyghur Genocide has written to Britain's Financial Conduct Authority, urging it to refuse permission for an IPO. It's retained a law firm to take up the case. That comes amid concern over labour practices in the China-founded company's supply chain. The group campaigns to protect the Uyghur minority in China's Xinjiang region, where the US and others accuse Beijing of running labour camps. This Reuters video from 2019 shows what China calls a vocational educational training centre. Officials have repeatedly and strongly rejected all claims of abuse at such facilities. However, Shein was forced to drop plans for a New York share sale after US lawmakers raised similar concerns. On Tuesday, Amnesty International said a London IPO would be a badge of shame for the city's stock exchange. It too accused Shein of questionable labour and human rights standards. Reuters sources say the firm confidentially filed for an IPO in early June, paving the way for a listing later this year. Shein has previously said it is strengthening its governance and compliance to address labour worries. The FCA has no power to investigate alleged breaches of legislation not under its remit, including the UK's laws on modern slavery.